We have with us Gaurav Kochar from Mirae Asset Investment Managers joining in on the show right now to talk about exactly that. Gaurav, hi, morning. Good to have you on the show. Help us understand firstly what the private banking market construct is looking like. Most of the earnings are now out. What's the SWOT analysis like?
Sure. A very good morning to you, and thanks for having me here. So, on the banks that have reported numbers so far, I think the common trends are that the liquidity remains tight. The deposit growth in this quarter has been lackluster. Having said that, 1Q typically seasonally is a weak quarter in terms of deposit mobilization. The credit growth on a YOY basis has remained steady. I would say 14-15% kind of credit growth at a system level. While we expected the credit growth to come down in this fiscal, given that clearly the deposit growth is in that 10-11% bracket, the credit growth would probably end the year at around 13%. So some part of it was already known that credit growth will moderate from the last year we were talking about 16-17% credit growth, which tapered down to 15 till about the end of FY24, and now we're talking about 13-14% credit growth. So that was one common phenomena across banks. The other bit was some bit of normalization in asset quality. While nothing alarming as yet, but in certain pockets, we are seeing some slippages build up. Now we need to see whether this kind of continues in the coming quarters as well, because 1Q again is seasonally slightly weak on asset quality, especially on the retail side. So we'll have to wait and see a few more quarters whether the numbers that we are seeing right now is just one-off or the trends are actually worsening.
Will this pressure on liability franchise, will it continue, and will this have an impact on the margins, or you think banks will be forced to increase rates?
Yeah, I think yes and yes. I think the pressure on margins continues. We speak to banks and they have been highlighting that the funding cost has been a key challenge. More so because the mix within the liabilities is the CASA as a percentage of liabilities is actually coming down, which is an indication of, again, the tight liquidity environment. The funding cost from here on as we speak is rising. The mix is also changing more towards term deposits and wholesale deposits, which will again impact the cost of funding for the banks. Having said that, the margins from where we see it, if you look at consensus numbers, most of us are building margin decline for the next couple of years, driven by funding squeeze, driven by rate cuts happening probably towards the end of this fiscal, and overall mix in liabilities changing. So part of that is already in the numbers. Whatever we've seen on the margin side from banks has been broadly in line with expectations. But to answer your questions, whether this tightness in the liquidity will continue, the answer to that is also yes. Perhaps if you look at the liquidity tracker that we use for banks, CD ratio is one that we use. If you look at the CD ratio at a systemic level, it's at 78-79%. Largely, if I look at the historic data, last 10-20 years, this is where this number has peaked. After which two things happen: either the loan growth slows down, or in order to match the credit growth, the deposit growth needs to pick up, which will again indicate that the price of deposits may keep moving up in order to meet the credit demand. So yeah, that to answer your question, yes, the liquidity tightness will continue in the near term.
Are you talking about all of this in the backdrop of the RBI circular, Gaurav?
That is different. Now, coming to the circular, while these are draft guidelines, draft circular, we'll have to wait and see how the final sort of paper comes in. But this, maybe this is perhaps on the backdrop of what happened. We are all guessing this is on account of what happened with the Silicon Valley Bank in the US, and there was this sort of liquidity squeeze on the bank. If you look at Indian banks, while I understand that Indian banks are differently placed, if you look at the balance sheet, what happened with SVB was more of the ALM mismatch. They borrowed short, and the investments were in the long-term securities. In India, if I look at the Indian banks, almost a quarter of the balance sheet is into liquid assets. So clearly, I think that way we are very differentiated. We already carry a lot of liquidity on the balance sheet, but perhaps we've seen RBI being a little more proactive on these things, be it on asset quality side or liquidity side. And to that extent, maybe this has come from that the liquidity on the balance sheet needs to be a little more tighter, a little more sort of liquidity on the balance sheet. This will have an impact in terms of if I look at the total liquidity cover today, most of the banks have reported a liquidity coverage of 110 to 120, 125 percentage. And if I assume that the draft guidelines are going to be implemented, then it has an impact of around 10 to 15 percentage point on banks liquidity. So which means that in order to maintain the current level of liquidity, they will have to increase the liquidity by another 10-15%, which will imply maybe a 1.5 percentage point kind of higher deposit growth from the current level, or maybe 1.5 percentage point of lower credit growth, because ultimately that is the money which will be deployed in the liquidity. So a 1.5 percentage point kind of higher deposit growth or 1.5% lower credit growth would imply some impact on the overall earnings. Different banks will see different challenges, but at a broader scale, I would say 3 to 5% kind of impact on overall bank earnings because of this, if this gets implemented.
So which banks do you think are going to benefit in this kind of an environment?
Sure. I think banks with very strong liability franchise, the large private banks, the large PSU banks, for which the deposit mobilization is not that big a challenge. While the challenge is real for all banks, but the larger banks relatively are better placed in this, given that they have the distribution and they have the systems in place to grow their deposits. Whereas the smaller banks will have to play the rate game. They'll have to up the rates more to give little more delta over the large banks to get more deposits. So funding cost will be the key sort of differentiator here in this cycle.
Which end in the financial space is cheap and looking attractive? Insurance, brokerage, private banks? What to your mind is fitting that cut?
Sure. I think valuations for the sector as a whole is still quite, benign. I won't say they are rich, barring a few pockets in the capital market space, and rightly so. I think the growth there is significantly better. So capital market is, a little rich on the valuation side. But having said that, if I look at private banks, or banks as a whole, the pre-COVID multiple is it's broadly trading at pre-COVID multiples. And if I look at the long-term average, they may be only a shade above the long-term average. So valuations are pretty much there. If I look at the credit cycle, credit growth, the return ratios, which is the ROA, ROE, I think they are tracking quite well. We are probably at a decadal high return ratios. So in that context, and given benign credit growth in double digits, I think we should be, the valuation looks very comfortable for private banks, especially. Coming to insurance, again, insurance has been lackluster. If I look at, last few years, they have not given much returns. But having said that, if I look at the return on embedded value, the ROEV for them has been quite strong. The growth, despite all the challenges that we have seen on the macro side, both on the regulatory front and the tax tweaks that the government has done in the budget last year, all of that, still the growth seems to be quite good in early teens to early to mid teens kind of volume growth for insurers. And in that context, the valuation looks quite steady. I think the valuation re-rating for the sector should continue going forward.
Okay, interesting to hear that, Gaurav. Thanks as always for taking the time out and joining us today. Good chatting with you.